Hello, everyone, and welcome to the Investing with IBD podcast, sponsored by Vantage Point. It's Justin Nielsen here, your host, and it is Wednesday, October 12th, 2022. And as always, I have joining me Arusha Pires. He's a portfolio manager at O'Neill Global Advisors. How you doing, Arusha?
I'm doing well, Justin.
Yeah, despite the market, which is always
Just hanging in
the
there as well as you could.
as
I'd
well as
say,
you could, sure. And you know what? This is going to be Portfolio Managers Squared because we also, as our special guest, we have another O'Neill Global Advisors portfolio manager, my good friend Charles Harris. How are you doing, Charles?
Hey, I'm great. Thanks for having me, guys.
Oh, absolutely. So Charles and I go way back. Seems like just yesterday, I guess it was 22 years ago that we were sitting next to each other, and I was watching you do your trades, and yeah, a lot of fun times outside of Bill O'Neill's office, and then eventually Charles moved inside Bill O'Neill's office. Worked very closely with him for a number of years. Gosh, how many studies have you been involved with and model
Oh boy,
books?
a lot,
Over the
a
years.
lot.
So.
Good times.
Yeah, absolutely. So we've got a lot of gosh, how long have you been at the firm now?
Can you
Because you
believe
started
it?
before I did,
I know.
and
I
I just
started.
celebrated 25 years.
So I
So
started September '95.
September
wow,
95. Okay, so you had
wow.
2 years on me.
So
So
like 27 years now, right?
hmm
Yeah.
Wow,
okay,
amazing.
I never thought it would turn into this, but I feel pretty fortunate. It's been a great place to be. I never. When I first started, I thought I'd be an analyst, like at
hmm
like a buy side firm or sell side firm. Like I got my CFA, like that was the intention.
Yeah,
But then I got the trading bug and managed to make a few bucks and turn into this. So I feel
yeah.
pretty happy, pretty
Well,
fortunate.
yeah, and let's not forget that one of the reasons why Bill O'Neill tapped Charles Harris as a portfolio manager was after having a, uh, a quadruple digit percentage return in a year that kind of got his attention and said, "Hey, why don't you come do that for me?" Very successful career there. But let's see. We've got a lot of learning lessons that we can talk about, but today we're going to talk with Charles about these secondary indicators and how you have to be aware of them, not put too much weight on them. You use them as a guide. And of course, as always, we'll go over some markets, get Charles' take on things, and get some stocks that might be on his radar. So how about we get started and let's pull up the Nasdaq Composite and see where we're at. I mean, it's been another. Uh, I, I'm not going to test you, Charles, on all of the market school rules. Of course, Charles Harris, Mike Webster, and I worked on market school together. And I'm not sure if you remember the distribution cluster. We just actually had a distribution cluster yesterday. And
Wow.
yeah, so yeah, he's like, memories.
so maybe define what the distribution cluster is for everybody, Justin.
So when you have a distribution, of course, distribution days are when you're down significantly and volume increases from the prior day. And one of the things that we found, and this was tricky because 10 years ago, we were finding distribution was not as useful as it used to be.
Right. Yeah.
And part of that was
Right.
because, I mean, we thought as a thesis, it might just be quantitative easing,
hmm
that you'd have distribution and then people were like, well, where else am I going to put my money? The rates are so low, quantitative easing is happening, and it would just go right back into the market.
Yeah.
But distribution clusters, when you had a number of distribution days, kind of in a short span of time, and we looked at 4 out of 8 days or 3 out of 5 days with distribution. So that's what we've had. We keep on having these distribution clusters. We haven't been able to make any progress above our 21-day moving average line.
hmm
Um, and we just on the Nasdaq and S&P 500, we're plumbing those lows. So we're at the lowest levels that we've seen in over 2 years. Um, it's been brutal out there. What's your take, Charles?
It's been brutal. I mean, you said it. It's been. I was talking to Arusha before we got started. I mean, we're in a brutal bear market. We haven't experienced anything quite this severe since 2008, and
Hmm.
then before that, the tech bubble burst, 2001 and 2. So it's been bad. I mean, the Nasdaq was at 36% off its highs yesterday at the lows. We've been in this since November of last year, so we're 10.5 months into a bear market that just hit a low yesterday. So, we haven't experienced anything quite like this in a long time. Seasonally, you know me, I'm always going to give you the give you the optimistic side of
The
things.
positive outlook. That's what we have you on for, Charles.
I mean, well, the truth is, eventually we are going to set up for an amazing bull market, and given the damage that's been done, I would expect it to be an extended bull market because so many stocks in the growth and speculative sectors are off between 60, 70, 80+%. So there has been the severity of the damage has been as bad as I've ever seen it in these sectors. And if we didn't have oil and gas leading us in more kind of defensive areas doing a little bit better, I think the indices would be down even much more. So there's been some offsets, but we focus on growth, and growth has been severely out of favor now for since last November, and before that, speculative growth peaked last February of 21. So I mean, or February of 21.
You got it, February 21.
So it's been a long extended downtrend, but again, seasonally we are in the time frame where the market has often hit lows and rallied into a year end. And when you've been in an extended bear market as we've been in, and the news has been so bad and consistently bad, people start to think in a very linear way and think, well, it's just always going to be bad, and PPI was bad, CPI will be bad, the Fed is going to raise again at 75 basis points, and it's hard to see anything changing when you've had. It's almost like we've been programmed to realize that things are just going to remain bad. But these Fed increases have occurred in such a short span of time. They haven't really had the enough time to really sift through the economy and have their desired effect. So I do think that that the Fed will get a hold of this inflation that we've been in. And you have to remember, like, this inflation was induced, kind of a post-COVID supply shock type of situation that hasn't been, we haven't had severe inflation for like 5 or 6 or 7 years. We've had it for a year and a half. So it came upon us quick. And I think, given how they've been raising rates, I think, and this kind of the news flow, like you hear things are getting worse. People are feeling it. I think a little bit of good news on that front. And they don't have. I'm not saying the Fed needs to go into easing rates, but just the market. The market perceiving, though, that they're getting a hold of inflation, and maybe we can start to not add to the rate hikes. I think could be enough to really get the market going again. So. Again, the market has been discounting, I think, a lot of this. And again, it's been very, very severe. And we haven't had we've only had one trading opportunity this whole year. Right. And that was, the June, July timeframe. We had, mid-June to mid-August, mid-July.
Maybe a little bit in March.
Very, very short, though.
Very short.
Right. So
both of them really very short.
Yeah, well, at least we had a couple months, mid-June, through, I guess it was August.
Yep. Yeah, the indexes peaked on August 16th, but, there was a little bit of chop back and forth at the beginning of July. And it was also a little bit tough in that the things that were working at first were really things just coming off the bottom.
Yeah,
it was your Shopify's, anything that was down 80% or more. that seemed like what was driving.
Yeah. No, we haven't really had we haven't had a tradable rally where we could trade base breakouts. You know, there's
Oh
been a
yeah.
few. There's been a few like things that are still on my watch list that have been coming off with the market, but are holding up relatively well compared to other stocks. You know, I think we're going to talk about them later in the podcast, but like Celsius or Shockwave, stocks like that. You know, there are maybe opportunities to trade those. But it's been, you know, what we want when the market turns is a good number of stocks that are setting up. And, you know, that hasn't been the case unless you're focused on the energy sector.
Well, if
And
you're waiting for a lot of stocks to a good amount of stocks to set up, it could be a lot longer,
oh,
right?
it's
It
going to
could be
be,
like 6 to 8 weeks for
oh, it could
a number of these
be,
stocks to build
oh,
bases,
yeah.
right? The earliest maybe.
Well, when the market bottomed in 2009, right? So we hit
Right.
the financial crisis lows in March of 2009. There was nothing to buy. There was like a handful, like Green Mountain Coffee was one of them, that actually broke out right around that time frame. But it took about 4 months before there were a lot of stocks that were actually setting up, because it took about 4 months for these stocks to build the right side of their bases.
Yeah.
So
Yeah.
so the market can stop going down. Well, it will stop going down well before there's going to be a lot of new merchandise to buy in the growth sector, because there haven't been any IPOs, right? That market, the IPO market's
That was a
been completely,
2021 thing.
yeah, it's been completely shut down this year. So there's no really new merchandise there. And everything else in the growth areas have been decimated. So yeah, I agree with you. I think that it will be months before there are a lot of good setups in areas that we like to play in. But the market will probably be rebuilding during that time frame, and we'll have opportunities to you know, to get in, you know, after follow through. Yeah, I don't anticipate seeing a lot of stuff to buy when we finally get a follow through day, assuming we get one, you know, early in a new rally. But we're nowhere near a new rally. We're just nowhere near it. I mean,
Right.
theoretically, you can get a follow through day, you know,
4
within a
days.
week, right?
Yeah.
4 days. So we can
Yes.
get one next week, perhaps. But
Right.
but I
So
don't
the
know.
setup will
I'm
be there.
yeah, I'm going to be optimistic though, and say that this kind of action in mid-October, I feel like I've been here a million times before, and so I think it's possible we can get a rally. I mean, I feel like the market in many ways is very washed out, and there are many of the contra indicators that I focus on that we're going to talk about that are, you know, kind of expressing very oversold, kind of one-sided. You know, everything's kind of on one side of the boat now, so I think, you know, it won't take much of a catalyst to get us moving. But that said, and that's, I think, the whole point of the second segment is going to be, don't over rely on these indicators, because they've really been given false indications the entire year. And I've been anticipatory based on these indicators, kind of trying to get in early. And it's only led me to losses. So you have to be careful.
Well, and you know, one thing I just want to mention on the 2009, because again, you're kind of, you know, you keep on saying, Charles, that this is the last time we had something of this severity was in the 2008 financial crisis. What was interesting coming out of that, while July was when things were finally kind of doing your traditional breakouts, this was one of the first times I saw Bill buying things underneath the 200-day moving average line. And it was
Buying
based on
stocks?
buying stocks, yeah.
Yeah.
And that was
So
in March of 2009, but they were still relative strength leaders. You know, these were the stocks that didn't undercut their lows when the market was undercutting its lows. So you had stocks like Apple, Priceline, Baidu, you know, Chipotle, CMG. You know, there were a number of these stocks that they were looking very different from the market in terms of how they were holding up, and that's what Bill keyed in on. So yeah, they weren't the traditional buy points, but there were some stocks out there for at least those first few months, but it was really driven by your Ford and your Bank of America and your Citigroup that had gotten killed down to $1. A lot of these were trading single digits that were bouncing, and when they bounced, it was like, oh, you had a couple 100% moves on some of these big cap stocks.
That's an excellent point, Justin, and I actually spoke about that on another podcast recently, that you don't necessarily have to wait months before you get a traditional, cup with handle breakout or double bottom or what have you. If you want to try to screen for stocks, as you mentioned, that that showed relative strength during this market downturn and did not have new lows when the market hit new lows. And you can measure that with relative strength. You can look for stocks where the AD line, advanced decline line, or accumulation distribution is showing strength. Fundamentally sound companies. So yeah, you're going to get spots to enter these stocks earlier, but you still want to enter them when they're starting to move up as opposed to sideways or going down. So you'll see like when Apple began to move up following the kind of 2009 devastation, it was holding up better, did not hit a new low, and it was breaking out of little base areas down near the bottom of the base. So at least you kind of had something visual that you could play off of.
Yeah.
So yeah,
and it was the leader.
It was the +3. The shakeout +3 rule.
Right,
yeah.
But it was also the clear leader in the market too, right? So, I mean that was the other thing. They were still growing dramatically, and so it was. If Apple wasn't going to work at that time, the markets were really bad.
Well, I always feel like the clear leader is so much more obvious after the fact, right?
That's true, but yeah, you're right on that. But when you were looking at the relative strength, they still had the numbers.
Yes,
and things like
it did
that,
have
right?
that.
And it was the big kind of liquid leader of the time. Right
Absolutely.
now, maybe Green Mountain Coffee Roasters was kind of one of the newer stocks, that Charles was getting into. But Apple was known kind of as kind of the key institutional leader for a number of years at that point.
And it had, I think it fell 56% or something like that, somewhere in the mid 50s during that financial crisis. So it got hit incredibly hard too. So
yeah.
That's what the market did. I mean, the market was down 57%.
Exactly. So and that's why I think the devastation this time around is as bad or even worse, because the Nasdaq's only down 36%. But like I was kind of making a list of some of the past leadership. NVIDIA 66% off its highs at its lows. PayPal 78%. Square 82%. Zoom 88%. Tesla 50%, Amazon 46%, Shopify 86%. I mean, this is like
when you say severity, this is.
I mean, it doesn't. I mean, these aren't stock. Most of these stocks are stocks that have earnings. They actually make money. Maybe the PEs are very, very inflated, but they're not pure speculative stocks. That aren't expected to have earnings for a decade. I mean, these are stocks that actually make money. At least most of them, like a PayPal or an Amazon or a Square, or NVIDIA. So, I mean, there's been an incredible amount of damage, and eventually the market is going to bottom. And again, we've had the speed and kind of the cadence of the rate hikes this year has been extreme. I mean, I don't really actually ever remember a period where there were rate hikes this many, and 75 basis points is a pretty big hike.
Yeah.
To do 3 or 4 in a row, I don't actually remember anything like that in the past. So it's going to have an effect, and I think the stocks are reflecting this, and I would like to think that when they're down 60, 70, 80%, that they've discounted a lot of what's going on. But listen, I've only been wrong so far, so eventually I'll be right. But yeah, I mean, I think this is a time to be very defensive, be out of the market. In our firm accounts, we're pretty much out of the market, and just waiting. And
Right.
and what do we do? And we thankfully we have a discipline, and that is wait for a follow-through day. And so just wait for a follow-through day. I mean, the beauty of that technique is that it will keep you out of the worst periods of an extended bear market when you think it can't get worse, and it just keeps getting worse. And so just sit on the sidelines and wait, and we'll have our opportunity. Again, as Arusha mentioned, there's nothing to buy anyway. So, and it's going to take a while for things to really turn around. So I wouldn't be too overly eager at this point.
Well, when we come back, we're going to talk a little bit about the secondary indicators that you might use in addition to the follow-through day, and see how they can be useful and see how they can lead you astray. Stay tuned. We'll be right back. Hey, trader. Will tomorrow be a market rally or a market crash? Well, you can finally stop guessing what's going to happen next. Visit www.freestockcoaching.com and find out how Vantage Point's patented artificial intelligence can forecast stock market trends up to 72 hours in advance with incredible accuracy. Vantage Point's AI technology analyzes huge quantities of global data in seconds. Check out www.freestockcoaching.com and experience Vantage Point for free. Learn how successful traders generate their wealth. Trading involves financial risk and is not suitable for all investors. Past results do not guarantee future performance. Go to www.freestockcoaching.com now. Okay, welcome back to the Investing with IBD podcast, sponsored by Vantage Point. It's Justin Nielsen here, your host, and joining me as always is Arusha Peiris, O'Neill Global Advisors portfolio manager, and this special week's guest is another portfolio manager from O'Neill Global Advisors. It's Charles Harris. So, Charles, we were talking about the market and all of the ways in which this has kind of been very washed out. So maybe share some of the indicators that you use to kind of give you that sense of how bad it's gotten on the sentiment side, those oversold indicators. So what are some of your favorites?
So some of my favorite indicators on the contra indicators or psych indicators are the Investors Intelligence Bull Bear Survey. And then the AAII Investor Sentiment Survey. So the first one is a survey of investment advisors, kind of professionals, and the AAII is a survey of individuals, kind of the broader public. I take a look at the VIX, volatility index. I take a look at the put to call ratio. I pay a lot of attention to the short-term overbought oversold oscillator, which has a decent record of marking lows in the market, but this year has been an exception. I look at the new highs and new lows, and I pay attention to the stochastics, among others. So those are the main ones I look at. And what I'd say this year is that I have over-relied on these secondary indicators to my detriment, because I've been trying to be a little bit anticipatory, taking stabs at the market here and there in the anticipation of a bottom, as opposed to just waiting for the follow-through day, which is kind of tried and true, at least. And this year has been tough for me because these secondary indicators have not really worked. The market hit new lows just yesterday. But if you look at many of these measures this year, they have the market has been very oversold by many measures the entire year. I mean, I was saying back in January, February, like, oh my God, we're way oversold.
Right.
And yet, we've been going down for another, 9 months, right? From we're 10 months. So it's been, I think the message or the lesson is they're called secondary indicators for a reason. You don't want to put, use them, but use them in conjunction with the follow-through day, or at least use them with the knowledge that they aren't always going to be accurate. And you can be, you can be right within a week, but in that 1 week, you can lose 20%, right? So, it's hard to time, but maybe we can go through a few examples and I can show you how usually they do a pretty good job. And so, again, we spoke about in the first segment that we're in a bear market that is, we haven't experienced this kind of bear market in a long time. It's been since 2008, 2009. So it's been, 12 years since we've been in this serious a bear market, whereas all the other corrections we've had since then have been either much faster to resolve or not as severe on the downside, but a little more extended to play out, like 2015, 16 kind of time frame, where it was just kind of, you wear them out instead of scare them out. This, I think, has been a combination of both. I mean, it's wearing us out and it's scaring us out.
So Charles, maybe like we have the screen of the NASDQ up here, an image from Wanda up here. Maybe walk us through a couple of the ones that probably your top two that you look at here, just to get like the indications on the secondary indicators.
Okay. Well, so on this image, the top panel is the put to call ratio. And we see a spike back in it looks like the June time period. So that first kind of low where that started that tradable rally.
Yeah.
We see a spike up to about 1.25 or so, 1.25.
Right. Yep.
And then just a week or two ago, we hit another spike at that level. So, of course, you can see that it did not mark the low because we went lower. So normally you get spikes where there's where there are, more puts to calls. It means people are getting very defensive and nervous, and oftentimes they coincide with market lows. This year hasn't quite again matched up. The panel below that is the bull bear survey results, and you can see that for a large part of this year, there has been more bears than bulls. And that's pretty rare. You don't go through long periods of time where that occurs, unless you're in a severe bear market, and which is what we're in. It's in most of the bear markets or the corrections we've had over the past 10 or 12 years, where the market was down, more like in the 20-25% range.
Yeah.
Or high teens. You never saw the bears exceed the bulls, or if they did,
I mean, those
maybe
crossovers are so rare.
They're very rare.
Once every few years, it would cross over maybe once, right?
And yet this year we've had week after week after week where bears have exceeded bulls. So that's really just informing us that we've been in something really different. Now, the panel below that is the short-term overbought, oversold oscillator. Now, I thought this was really interesting. Back in January 27th, so that was that low that you're pointing to right now.
Yeah.
The NASDAQ hit a low of 1897, minus 1897. That is the lowest it had ever been in the history of the NASDAQ.
Wow.
So
it's ridiculous.
And yet that was in January.
Yeah.
And and that did mark a kind of, I think, a short-term bounce, but it wasn't really tradable. Interestingly, the second worst reading was October 28th of 87. Where it was a minus 1714.
Wow.
That was the low of the market in the 87 crash. So that was the low point. So in 87, that spike down actually did mark the low.
Yeah.
So I was kind of optimistic that, oh, look, we have another, historical spike down, never happened before.
Yep.
The market's going to recover, and yet this time around it didn't. And keep in mind that the 87 crash was a very short bear market. I mean, it was a crash.
Yep.
And then it took a number of years to kind of come back, but it hit a low and then it worked its way back up. Before the 87, the next lowest one was September 1st of 98, which is the oscillator hit a minus 1500. And that was the bottom of the first leg down of that 98 market. If you recall, we had a severe bottom,
Yep.
and then we had a tradable rally up to the 200-day,
Yep.
and then a shakeout undercut. And then that began the great last leg of the bull market.
Yeah.
That took us all the way up to March of 2000. So we're really in kind of unprecedented territory. And you can see that just a few weeks ago, the market hit another low of 16, it looks like around 1650 or so, which is the third or worst rating in history. And so, by these measures, you would expect us to be somewhere near a low.
Yeah.
But
now
again,
the only thing though, so those other two examples, 87 and 98, you had kind of that big kind of washout, right? A huge kind of sell off.
It's very quick and severe.
Yeah, here we haven't had that yet.
Well, but we did in January. It was pretty quick and severe in January. It's just that it's been so persistent.
True,
right?
True. Yeah. So in the January we definitely had it, but for this last time, a few weeks ago, we haven't necessarily had it, right?
Yeah.
Well, it definitely. Again, we're in a different kind of bear market because again, this is an extended bear market, whereas 98 was a 3 months down, NASDAQ correcting about 32 or so percent. We're down 36% at our lows over almost 11 months. So it is a different play. But I will say that, I don't know about you, I'm feeling a little panicky. I mean, it's been pretty bad.
Right.
And I do think there's been a fair amount of forced liquidation that no one's talking about, but I think, people who are holding on to, I mean, I've sold a ton of my Tesla. I mean, if I've just can't hold, I mean, I still own a lot of it, but it's been, I've actually converted a lot of my stock to leaps, just to kind of raise cash and not, play it on margin so much. But it's been, it's been devastating. I mean, it's been really bad.
So you're talking about so we've all been pretty nervous, right? And we're getting a little bit more panicky. And we were talking about this before we started recording. I feel like just the Main Street America, I don't feel the panic necessarily from them. They're not really paying attention to the stock market just yet, right? A lot of times when you get that panic, then all of a sudden we'll all probably start getting calls from people who aren't really watching the markets and asking us what's going on with the markets.
Yeah, that's true. I mean, I remember at the COVID lows, I had tons of people calling me like, "Oh my God, what's happening?" And you're right, maybe because it was so, over 6-7 weeks, people are losing, half their money or more. This is almost like the, boiling the lobster, a lobster in the kettle or the frog in the kettle. Like, you start it slow and you don't realize you're boiling until it's too late.
Yeah.
It's a different feel. You're right. I haven't had a lot of inquiries like that, but
now it's not a requirement. It doesn't have to happen.
It's not a requirement.
But that's the one thing that's been in the back of my head that I just haven't seen that out. And like everywhere you turn, like any TV channel you turn on or whatever, they're just talking about the market and everything blowing up everywhere, right?
I don't know. I almost feel like people have given up though, because let's just pretend that you're in the market and you're holding like an ARK fund, like that I lost a ton of money on when I went in early in the year.
Right.
I never dreamed. I thought they were probably near the lows, right? They're already down 50%. I took like 20% losses on them, and they went down another 50%, right? So I mean, if you're in speculative areas and decided not to sell, if you're not panicking now when you're down 80%, then I
Fair
think
enough. Yeah.
you've probably given up and you're like, well, whatever, it's not all my money and you know what I mean?
I'm
Yeah.
down this
Yeah.
Like
much. What's
there's been enough reasons to panic. I mean, if you're
Yeah.
down that much, I think you're pretty much like, I'm never gonna sell, whatever, you know? So I don't know. I mean, it's been brutal. You know, I was looking at some of my notes and so the investors' intelligence, you know, came out today, right?
yeah, right.
And bulls were at 25%, bears were at 44.1%, which is a very extreme reading. The spread is a negative 19.1%. That's the largest spread since 2009. So, you know, these are like readings that you get at the bottom of major bear markets. You know, you never know. I mean, if you maybe, Arish, you want to pull up maybe a monthly of the bears, and if you see that, and you can kind of see one reason why I pay attention to these indicators. When you put up the chart, I'll show you what I'm talking about.
Yeah, we have a little transition time here,
Okay.
but I just want to mention that for people that are maybe not watching the video that are listening to this, if you want to see these charts, they are available on the video portion. You can get that at investors.com/podcast and see these charts and the panels that Charles was talking about. But here we go. Now we've got the MarketSmith chart up, and by the way, you can also most of those that Charles was going over. He was going over them on Wanda. You can get most of those by typing in NASDQ on MarketSmith as well. So the put call ratio isn't on that panel, but you can get that elsewhere. And I can also show you some areas on investors.com where you can get those. There's the psychological indicators that you can get you know, under the market trend. But go ahead,
Yeah,
Charles.
you can get the bulls and bears and
The
on
bulls bears, so
investors.com
you can
too,
get you
right?
can see those crossovers.
Yep.
It's nice because it's got a red line and a green line. You know, the put call ratio, and yeah. So Charles, why don't you go ahead and talk about this chart here that we're looking at again on MarketSmith. This is 0 BEAR, 0 bear, and this is a monthly chart. So
So
tell us what you're seeing.
this is showing the readings of the bearish advisors on this survey, and you know, there were some very, very extreme readings during the 2008 period, right? And that was, you know, the financial crisis, you know, really a global meltdown. I don't feel like I'm going to even use that as a comparison because I don't think we're in anything like that. I mean, certainly the fundamentals, in my opinion, don't warrant that. I mean, you know, we've pretty much record employment. The economy is still has been strong, even though it's hopefully slowing, so that inflation slows. You know, really, the only main thing that's killing us right now is inflation, really, and you know, the whole disruption in the supply chain. But if you look at, you know, some of the other readings, so in the September 2011, we hit at 46.3%. We're currently at 44.1%, so we're pretty much there. That marked the market low in September 2011. That was a low in the market. Then the next reading,
Global
July.
recession fears were going on at that point. That you had the Greek debt crisis.
Right.
But what was interesting is you didn't actually have your follow-through day that worked until December 20th of that year in 2011. So, you know, you kind of slopped around a little bit after that low.
Yeah.
So,
But that was the low.
Yeah.
I mean the spike in bearishness coincided with the low in the market, and then yeah, it took some time, I guess, to come out of it, but at least you weren't going down further, and there are probably things you could start building your watch list and maybe
Right.
start, you know, the trend started to be on your side, or at least not against you.
Yeah.
January 2016, we had a spike up to 39.8, so we're higher than that now. That also marked a market low. Didn't go lower from there. The market continued to rally up and, you know, in a bull phase. Then we had the 34.6% spike in December 2018, also coincided with a low in the market, and a bull market after that. And then in February 2020, so that was right around, that was the COVID low, right?
Yes.
Yeah.
So that was 41.7%. So we're higher than that now. And that also marked the low of the market. And then more recently, just back in May, we hit 44.1%. So we're right back at that level.
Wow.
And that was the one instance where you didn't get a market low. You did get the beginning of a tradable rally, though, right? So we're right at these levels where, in the past 5 times, we've either hit a definitive market bottom or at least a tradable rally.
Mm-hmm.
And again, this is also coinciding with a low in the stochastics. We haven't been this low in the stochastics since 2008, and before that, 2002. We have all these, the AAII survey has been very, very negative. Bullish readings in the teens to 20s. And bearish readings in the 50 to 60%. So again, everyone's kind of on one side of the boat and expecting the worst. And so that might set us up for an opportunity. But again, we should wait for the follow through day because, all these indicators are saying, hey, we're near a low, like go for it. But the market has not been cooperating, and who knows? I mean, it can get a lot worse in the short term and say, oh, well, I was off by a week, but you can get creamed in that week.
Yeah, I mean, like
So,
if you go back like to like March of 2008, that was getting up to a high of 44.70, just like you were saying, Charles. You had here, you maybe it was like a short-term low, in hindsight, but then it went up to that 64.40, right?
Oh,
so,
yeah, no, that was
really
like
good point.
Insane, yeah. So yeah, again, use these as kind of to inform you of what might be happening, but play it safe and wait for a follow-through day, because the follow-through day consistently has worked with every major market turn. It's not going to get you in on the bottom day, but it's not designed to. It's designed to get you into the market when the trend is your friend, or at least there's that possibility. And it's a way to get in prudently without risking too much.
Mm-hmm.
So,
and a lot of times I guess I look at the secondary indicators, the value of them is it kind of gives you the sense that you're in an environment where things have gotten to a point where a follow through day might be more meaningful, because you get false follow through days, right?
Yeah.
All the time. And sometimes I look at, if you got the secondary indicators telling you, you've really washed things out a bit, then it's a more meaningful follow through day as opposed to something where, you know what, you just kind of came down a little bit, you really didn't wash people out, and it doesn't give you the sense that you can have a real powerful rally afterwards. So I guess sometimes it gives me that extra optimism that, what could follow could be even greater. But one thing I just want to mention, because I hadn't noticed this before, but 1994, there was a pretty big spike there. The bears actually went up to 59.1. And it was interesting because we were kind of talking about that 94 correction. There was a major rate hike cycle there. Seven rate hikes. This is something that David Chung and I talked about on a podcast previously. But it wasn't the 75 basis points each time like we've seen this time around. It kind of ended with that 75 basis points and then another 50. But what do you make of that? That wasn't a very severe downturn in 94. You mentioned that it was just 14% of a correction.
So I was actually I actually tweeted about this, and I was wrong, but I was using 94 as a precedent for this time period, just based on the interest rate hike cycle, which again started slow with 3 quarter point hikes, and then two 50 basis point hikes, and then ended with a 75 basis point. So the total rate hike was 2.5% back in 94. And again, it happened, 7 increases that year. So this year we've already exceeded that. Now we're up to 3%, aren't we?
Yeah, I mean, so you went from 3.25 to 6, because I also included in that cycle, there was a February 1st, 1995, which was 50
Oh,
basis
okay,
points
okay,
right after the
okay,
75. So,
okay.
so yeah, there were 6 in 94, and then there was that one last one to kind of cap it off in February of 95.
Yeah.
Yeah.
Yeah, no, I thought, as we mentioned, off air, conditions were different back then. The 94 bear market was is much less severe, just down 14% on NASDAQ. From high to low was just 3 to 4 months. Interestingly, though, one thing I did when I'm kind of looking for precedents and looking for market precedents, the other part of that isn't just looking at, well, how did the market behave, but what were the stocks that came out of those periods? And two of the stocks that came out of those periods, one was Cisco. So Cisco was a gigantic market leader going into 94. Like from 91 to 94, it was up, I don't know, let's just say 500%. It was up a lot. I'm not
A lot,
sure
yeah,
how
it
much.
was in the thousands.
It was up a lot.
Yeah.
And then it had about a 50% correction during 94. And it came back to lead again. So,
Very long base.
a long base, rounded out. It actually hit a low after the market hit a low. Interestingly, yeah. But I printed that chart out just to kind of inform me of, well, how did it act? And it gave you many opportunities to get in before it actually broke out of a cup with handle. But it took a long time after the follow through day to actually break out of a full-on cup with handle. So you're going to have time with some of these. And like, I still have a big position in Tesla, which is looking terrible. But maybe that's going to be kind of like a Cisco, down 50% and eventually build a base. And maybe some point next year, it actually completes the base and is, maybe up near the 300 or 400 range, closer to new highs where it gives you a proper setup. But the other stock that broke out in 94 was Ascend, which was one of the greatest model book stocks of all time.
Right.
And so it had IPO'd, and it was bucking the trend. And when the market took off, it really started to take off. So looking at, looking for merchandise like Ascend that this seems to be bucking the trend and doing better, that's where my focus on like Shockwave or Celsius comes in, because these are kind of newer stocks that people haven't heard of. And, I don't know that the market opportunity is the same as like an Ascend. Ascend was in the networking space at a time when,
as was Cisco,
and Cisco, and this is at the, the kind of the beginning of the internet, like when things are really starting to grow. So they were like really in the right place at the right time. So I don't know that the market opportunity is similar with some of these other stocks we're looking at today, but there's a lot of things happening, in the world, with AI and electric vehicles and biotech that are going to have huge markets. So there's going to be another stock like that that's going to come out of here. So, that's really what I think where you want to screen is for stocks that are showing incredible relative strength in this market weakness, and are the first ones to come out that have really great total addressable markets, and they're leaders in their space.
Well, when we
And
come back,
I should say before you transition, Justin, I should say that we own both Celsius Holdings and Shockwave Medical in some O'Neill funds.
yes, good point. So good disclosure. But when we come back, we'll talk a little bit more about some of the stocks that might be on Charles' radar, and maybe we'll get some more disclosures from Arusha on that as well. Stay tuned. We'll be right back. Stock market have you nervous with massive fluctuations? With the impact of inflation and the upcoming midterm elections, it's virtually impossible to guess what will happen next. But with Vantage Point, you won't have to guess. Visit www.freestockcoaching.com to find out how you can forecast market trend changes with up to 87.4% proven accuracy. That's right, 87.4%. Visit www.freestockcoaching.com and find the consistency and confidence you've been looking for in your trading. No more guessing when to get in or out of a trade. Protect your hard-earned capital with Vantage Point. Trading involves financial risk and is not suitable for all investors. Past results do not guarantee future performance. Go to www.freestockcoaching.com now. Okay, welcome back to the Investing with IBD podcast, sponsored by Vantage Point. It's Justin Nielsen here, your host, along with Arusha Pires, who joins me every week. He's an O'Neill Global Advisors portfolio manager, and we're lucky enough to have another O'Neill Global Advisors portfolio manager, Charles Harris, joining us on the show this week. And Charles, you were talking about some of the stocks that could be setting up, maybe have those strong relative strength characteristics. Let's talk about some of the stocks that are on your radar. And you've mentioned Celsius and Shockwave a number of times, so I guess we can just start with those. Let's take a look at Celsius, ticker symbol CELH. And of course, for those that are watching the video at investors.com/podcast, you can see the Market Smith chart here. With the market below its 200-day moving average line, below its 50-day, really below all the moving average lines, Celsius is holding up pretty well.
Yeah, it's come down with the market like everything else, but given that it broke out during that kind of tradable rally, and it's pulling back with the market, I think it's holding in there much better than most. It's a high PE stocks. I mean, it's a speculative stock, but with it's in kind of an industry I would consider it's a little bit faddish in a way, with that kind of energy drinks, Monster, and what's the other one?
Red Bull.
Red Bull, yeah. But I actually tried the drink. It's actually pretty good. I think that their marketing is great. I think it's a good product, and fundamentally, importantly, they have a distribution agreement with Pepsi. Mm-hmm. And there's also been talk that Pepsi might acquire them or have a stake or take a stake. So
I mean, it's so similar to Monster, like 15 years ago, right? Where
totally.
Coke and Monster
Coca-Cola got the
distribution
same kind of down.
Yeah,
totally. And this is a small cap compared to those other ones. So
well, back before it turned its name to Monster, and when it was still Hansen Natural, it was a small cap.
It's small, and it turned into something really big. So I mean, I think there's potential here. Relative strength is great. I think it's got a good story. They should have triple-digit earnings going forward. Mm-hmm. They had a great conference call, and it's energy drinks. It's not, something I think that should be so affected. If you're into energy drinks and you're into working out and so forth and want to do it in a relatively healthy way, this is probably where you're going to turn. And so I like it. I think it's, when the pressure of the market comes off, these are the stocks that should do well and maybe be new leadership. So that's what I'm looking at. I'm not saying you have to be involved with it now, but this should be on your watch list, waiting for the pressure of the market to come off, waiting for a follow-through day. And this might be one of those that gives you an opportunity once that happens.
Yeah, I mean, it potentially could put in, it's 23% off its highs right now. Maybe it puts in a cup here. It has that strong prior uptrend. Maybe it sets up for the follow through day and the next rally. And I mean, I think one difference with this is energy drink, but it also, I guess, burns calories too. I think that's their kind of shtick here, right?
That's the marketing. I read through all that. I mean, who knows? I don't really listen to any of that kind of diet type stuff. It
Yeah.
seems like every year there's something, and they find out a year or two later do the opposite. Like high carb, low fat. Now it's high fat, low carb.
Right.
Don't
It
drink
is.
coffee. No, you should drink coffee. Don't eat chocolate. You should eat chocolate. I mean, what can you even believe anymore? So
Right.
honestly,
It's
I
hilarious.
just think everything in moderation, and you're probably going to be okay. Um, but
So,
yeah, that is part of their marketing, is that it burns calories, and so hey, I want to burn calories, so why not?
Yeah.
yeah. So you mentioned how this has kind of that fad type to it. And I mean, when you say fad, I mean certainly, Monster had that, but also think back to like the 80s with like LA Gear and Reebok
Mhm.
with, the aerobics
Yeah.
craze and everything, and fitness, and we saw that with Crocs, right, back in 2007, and
Yes.
then again after COVID. So do you handle, something that has kind of that faddish quality a little bit different? Because I feel like sometimes those fads can be a little bit short-lived and very, I guess,
Yeah.
uh,
Well, I mean, and I could be wrong. I mean, I just think it kind of has that quality because these
oh, I
types of
agree with you.
things
Hmm.
typically go in and out. So
Hmm.
yeah, if I'm in something that I feel is more faddish, I'm looking for the move to be a lot shorter. But you can get some of the biggest moves ever in these types
Right.
of stocks. So like the one I always go to is Pokemon.
Hmm.
KIDE was the ticker for
Yeah, I
kids,
remember that.
and
Yeah.
it had like a tenfold move in like, I don't know, 6 months,
Wow.
something like that, and then it
I
just
mean, that was like the
crashed.
.com, the whole the during .com,
It
right?
was
It
actually,
was
I think
It was
99,
after that, I
it
think.
was
or was it
after
after that?
it was
Okay.
after
Yeah.
.com. I think it was like in 2000. It was after the bust.
Okay.
It
Wow.
was definitely after the bust. Taser is another
Hmm.
one.
That's
Hmm.
right.
Where like I remember I was playing Taser, and they're like, there aren't gonna be any more guns. We're just gonna be tasers, and they're gonna be
Yep.
in all the police cars and all the aircraft and all. And it's like it just took on a life of
Yep.
its own,
Yep.
and until it didn't. So yeah, to answer your question, do I play them differently? Yeah, I mean I'm kind of looking for a faster move, and then maybe a burnout. But I have to say that these energy drinks are I could be wrong here with regard to fad, because I actually thought Hansen was a fad stock,
Hmm.
and Monster Beverage, which it turned into, and people drink these things. I personally think they're undrinkable. I think Celsius is actually pretty good. I don't know how anyone can drink a Red Bull or a Monster or what's it called, a Rockstar, I guess is another
Oh,
one.
that's
Like,
right. Yeah,
Oh,
that's
right,
another
yeah,
right.
one.
Yeah. Hmm.
I I I I think they're pretty disgusting personally. I don't drink them.
Yeah.
But people love them, and people feel like it gives them the lift they need, and they've been around a long time now. So I could be completely wrong with the fat aspect of it, but the calorie burning part of it feels as faddish to me.
Hmm.
Hmm.
you know but I could be wrong. It could be persistent, but I think it's a large enough market, and they're a small enough company with a small enough market share that they can, I think, take a lot of market share from some of the incumbents. And so I think there's there could be an extended move in this.
Hmm.
If it works. I'm looking at it that way.
Mhm. Well, and it's the same way like when you have kind of a restaurant chain, that just starts out, and then you see their expansion. Oh, we're opening up all these, not just restaurant, but retail chains. Oh, we're opening up all these stores, and you see a Chipotle Mexican grill go from this small company to now it's everywhere, or Starbucks on every corner, or what have you. And so, I certainly see, every time I go to the gym, they have a nice little Celsius display right at the front there.
Well,
So it's definitely out there.
Yeah, their
So
marketing is really strong too, and they're pretty slick. So
mhm,
yeah. See what happens.
Well, let's go from what some argue, because I will mention that Charles did put healthy in quotes. So what some argue may or may not be healthy with Celsius, let's talk a little bit more on the health side with Shockwave, because certainly one of the things that we struggle with in America still is heart disease, and cardiovascular is one of the big killers, and so Shockwave is doing something with that. SWAV is the ticker symbol on this one. What's your take there, Charles?
So this is another example of one. It's not that different from the Celsius chart in that it broke out and is now coming down with the pressure of the market. And again, we're looking for stocks that are showing extraordinary relative strength in a very, very poor market. And this is another one of them. And again, this is a new approach to cardiovascular disease as far as opening up arteries. And you can see the numbers below, huge growth numbers. And I don't know what the total addressable market is, but I know cardiovascular disease is a pretty prominent
pretty
thing
big.
around the world. So this, and it's shown a history of being able to rally and make big moves, right? It's got that prior uptrend. So, you combine the relative strength in a very poor market with the fundamentals and with a history of being able to move. And, these are the stocks that I want to look for to lead in the next bull market when it gets here. So, these are how, the types of stocks I screen for.
Yeah, so this is it's working on pattern recognition's picking up a consolidation right now, a little bit below the 50-day moving average, but yeah, overall, I mean this is a chart that really sticks out versus pretty much all of the other stocks in the market.
Yeah, I mean, look, this pullback in the Nasdaq has been extreme.
Right.
I mean, it's been bad. So, if you're a little bit under the 50-day, but you're still well below the pivot and well above the pivot, I mean, that's pretty amazing given that your market's at new lows.
Right.
So,
and that's where you put that in the perspective of where it came from. The fact that it's held on to a lot of those gains, is pretty impressive. I mean, yes, this is a 22% correction, but look at how far it came. It's still in the upper part. I mean, again, you look at that weekly chart or the monthly chart, and it's still way up there.
Well, what's the Nasdaq down off its high? No, I don't mean its all-time high, but the high in August.
Oh, geez,
a lot.
Yeah, a lot. Yeah, a lot.
Over 20%.
Probably 20%. Yeah.
So if you're in a high beta stock that's off 22% and your index is also off 20 something percent, that's why the RS is high. I mean that's showing you that I mean there are a lot of stocks off 30-40% or more just since the highs in August. So it's been brutal. And then when I run screens, not a lot is showing up that I'm not excited about. There's a lot of stocks that are still in the oil gas sector that I just don't play. I mean, and I get why they're working. I guess I see oil prices are high. The supply demand dynamics globally are in favor of this. But I also know, I'm going to get a bunch of people tweeting me that I'm way ahead, but fossil fuels, it's not going to be a secular growth industry in my opinion. We are converting to electricity and clean energy. I mean that is a trend that every government around the world is adopting. And so we're in a transition period where, there's still going to be obviously fossil fuels for many, many years, but I think the story's been written that there's going to be a slow transition away from it. And So I don't want to play, for me, I don't want to play themes that I don't have a long-term belief in. I want to play themes that that I do have a long-term belief in, which is why I'm continuing to hold Tesla, which has been very bad to me this year, to be honest, as you know. It's been bad. Had a few great years and it's been brutal. But but my enthusiasm and belief in the stock hasn't been hurt at all. I mean, to me, the news only is getting better, and there are more and more catalysts, and I understand that the pressure of the market is getting to Tesla along with almost every other stock. And so when that pressure comes off, and it will at some point, the stocks that have a true future are going to show. And so, you know, that's why I'm looking at, that's why I own Tesla. That's why I'm looking at Shockwave. I've actually been involved with Shockwave and Celsius during this time frame. I've been trading them. And I think that, you know, I don't know when we're going to hit the market low, but the secondary indicators are pointing to the fact that we should be somewhere near that. And the market just feels pretty washed out, but you know, who knows? Let's wait for that follow-through day. But I think these stocks that I believe have true futures will be the ones that perform well when that time comes.
Well, maybe to transition from that kind of oil and gas and the old energy discussion, maybe you talk a little bit about the new energy with First Solar, ticker symbol FSLR.
So yeah,
Certainly, this is an area that has had moves in the past, very strong. Is it able to make another move? Is this one of those
so
rare situations where it can come back?
again, another similar chart in a sense to those first two, Shockwave and Celsius. You know, stocks that have hit new highs recently and are pulling back with the pressure of the market. This one's actually really holding up well, sitting on that 50-day. And you know, solar has been the world is converting to solar and wind and other clean forms of energy. And I think with the pressure of the market, people are almost forgetting about this huge bill that just got passed by the government, the Inflation Reduction Act, where there's a lot of kind of government support and subsidies and so forth for clean energy. And I think it's going to have its impact. And again, it's just a matter of time, I think, before you know, this conversion, you know, where more and more people are adopting these forms of energy. And you can just see it in the chart. You know, the relative strength is a 99. And the fact that it's holding up as well as it did in this terrible market, you know, it's been a leader in the past, you know, way in the past, as Justin and I were talking about it off air. I mean, I played it. That was the first move I played in it. And boy, it was a big, big winner. And it's gone through a 15-year dormant period, really. So maybe it shows leadership again, you know, coming out of this bear market when that happens. So that's another one on my list.
Yeah, I mean, it's potentially, it could be putting in a flat base here in the near future. I mean, it's only off 13%.
I mean, I don't even consider it basing. To me, it's broken out and it's just in a pullback.
Yeah.
Okay.
It's not even pulling back so much as it's letting that 10-week line just catch up with it.
Yeah.
Right.
Letting it catch up with it. So.
Yeah, and again, it's happening in the context of incredible weakness in the overall market. So, so we'll see. Not all the solar stocks are working. You know, that Enphase was doing great, and it's come under a lot of pressure now. I think there was a downgrade in the past few days. I think I'm not 100% sure on that, but I think there was. This is another great company kind of supporting solar. And maybe it comes out of this too. I mean, I usually don't pay too much attention to downgrades. Usually the effects are pretty short term, but we'll see. But I think this also belongs on a watch list.
Well, I think you gave our listeners some good things to think about, and also just keeping an eye on those secondary indicators, but also waiting for the primary indicator, of course, being price and volume with those market indexes and the individual stocks showing the strength that we need to lead another future bull market cycle. So thanks a lot, Charles, for being with us again today. It was great seeing you, buddy.
Thank you. Appreciate it. Great to see you guys.
And I'm sure we'll see you again soon. We'll have you on because, hey, it's always fun having you. On the show next week, we are going to have Thomas Carr joining us. He is the founder and CEO of Befriend the Trend Trading. So I'm sure we'll be talking a little bit about trend spotting with him. So hope you join us for that. And thank you for joining us this week. We'll see you next time. Take care. Make sure to subscribe, rate, and review our podcast if you haven't already. We'd really appreciate it. You can also send us your questions and comments to investingpodcast@investors.com. We would love to hear from you and may use your comments on an upcoming episode.
Hey everyone, thanks so much for watching Investors Business Daily on YouTube. If you want to watch more videos, make sure you hit that subscribe button so you don't miss a thing.